This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, you're listening to the AJ Bell Money Markets podcast, and it's our monthly episode dedicated to investment trusts. Now, we've got some great guests on the show, all providing fascinating insights into the world of investing. My name is Dan Coatsworth. Joining me this week is Laith Califf.
Yeah, thanks, Dan. Now, a lot of listeners have been asking about the technology sector, given it's been one of the best places to make money in recent years. So to tell us everything about the space, Steve Frazer from Shares Magazine has been to chat with Mike Seidenberg. He's the fund manager of Allianz Technology Trust.
And that conversation is coming up in a second. And so is a chat with Joe Bauernfreund from AVI Global about the world of activist investors. Tom Sieber from Shares Magazine will also be talking to Urban Logistics Justin Upton about the property sector.
Now, each month we do a deep dive into an investment trust chosen by listeners. And in this episode, we're going to explore Bankers Investment Trust. Martin Gamble and Ian Conway have been sifting through its strategy, and they've got some very interesting insights to share later in the show. First up, let's bring on Tom Sieber to talk news in the investment trust space. Tom, what has been going on?
Thanks, Laith. Yeah, so this is kind of a bit of a link, I guess, to the interview we've got on tech later on. But it'd be no secret to anybody that the big driver of returns from the US and therefore global stock markets over the last couple of years have been the Magnificent Seven tech names. So as a very quick reminder, that's Nvidia, Microsoft, Tesla, Apple, Meta, Alphabet, and Amazon. Nvidia recently gaining and then rapidly surrendering the mantle of the world's largest company by market valuation. This has led to obviously lofty valuations and quite significant market concentration risk. And there's some examples recently of fund managers reacting to this by reducing their exposure to these companies. So some research recently published by Stifel noted that the Magnificent Seven exposure at JP Morgan American had remained at 27% between the start of the year and the end of April. So you might think no change there, but obviously that's been quite a strong performing part of the market. So the fact that it's remained the same despite that suggests that they've been trimming their stakes in this area. Notably, the trust has entirely exited its position in Tesla. And the manager of the growth subset in the portfolio, she's called Felice Agranoff, is on record as saying that the easy money has already been made in tech. And while she remains upbeat about AI, she expects the market to differentiate more going forward. I guess this is a real challenge for all US-focused trusts because the market in the US is so dominated by these firms. And if you were underweight, i.e. had a smaller position than the market, than the market did in them in recent years, you would really struggle to match the performance of the wider market. But then clearly now you've got these risks that potentially, as JP Morgan American's been talking about, they're potentially overvalued.
Yeah, I mean, their Security Trust of Scotland is another investment trust. And if you read their latest sort of commentary in their fact sheet, they made a point that they'd just been over to North America to do a series of meetings. And they sort of said that, things seem to be shifting a bit because, a couple of years ago, they did the same thing. And at the time, Jamie Dimon, who runs the JP Morgan, the banking operations, he was sort of saying that there was a potential hurricane if interest rates were sort of surging as they were at the time. This time round, he appears to be a bit more worried about inflation and the potential for actually interest rates to go up again, not to be cut. So, but he's also making the point, there are definite clear concerns that the market may be overvalued to the point where he wasn't really sort of positive enough to be able to justify JP Morgan buying back its shares at the current level. And he's not saying that JP Morgan wasn't being sort of properly valued relative to market. It's just saying that the market's high and he thinks it's a mistake to be using capital at these levels. And so Securities Trust of Scotland was making the point that now that interest rates have actually they've gone up faster than what we've seen for the last 40 years, and with US markets trading pretty highly, it thinks it's a really good reason to be cautious. So I think if anyone's sort of investing in in the US market, if you're looking at the indices at the moment, you're thinking, okay, it's all fine, everything's sort of still tilting upwards. But I am hearing more and more people getting slightly nervous about markets being a little bit toppy at these levels.
Yeah, thank you, Dan. So potential frothiness in the technology sector. It feels like that's been the story for quite a few years. And, the market does seem to just relentlessly ratchet up, which does kind of lead you to question whether when the fall comes, it's just going to be even bigger. But, I think technology has been incredibly influential, of course, over the last 20 years, both in terms of how it's transformed our day-to-day lives, but also the effect that it's had on the market landscape. So to discuss all things technology, Steve Frazer from Shares Magazine has been speaking to Mike Seidenberg, fund manager of Allianz Technology Trust. Here's what he had to say.
There's only one real place to start a conversation about technology at the moment, and it's really around AI and the incredible success of Nvidia. I mean, these have been the two kind of key talking points for at least the last 18 months or so. And you throw in names like Microsoft into the mix as well. And they really have created quite a stir among investors. Now, I'm curious because what Gartner has this hype cycle it talks about in terms of investors. They hear about a new technological development. They get very excited about its potential. Then as they realize that these things tend to take longer than expected, they tend to be a bit more costly than expected. They tend to get a bit despondent with things. And then over further months, and as returns start to show up on corporate profitability numbers, they start to then draw back investor enthusiasm to these themes. So I really wonder if you could put into a context on that hype cycle where you think artificial intelligence currently sits.
Yeah, it's a great question. I mean, in my background probably helps here. I worked at Oracle Corporation after business school and before coming to the buy side. So I've seen a lot of hype in technology in my 20 plus years. I think it's important to delineate between what is secular and what is a hype cycle. And by the way, there are bound to be stocks zig and zag throughout that. But I think it's important to understand that the artificial intelligence as a horizontal technology is really something that is very indicative of other themes we've seen throughout my career, whether that is movement to the cloud, whether that is software as a service, these big, secular themes that tend to, create budgetary dollars for the beneficiaries. I don't think artificial intelligence is hype. I do think that, we will zig and zag throughout the process. But the power of the solutions and what we're seeing today, and this is just the beginning, I don't, there may be a little bit of froth in the market around it, but the results that companies are seeing that basically implement it, whether it's, listening to a company like ServiceNow talk about what they've seen as they introduced artificial intelligence to some of their products, listening to Microsoft talk about Copilot and what it means for developers. Ultimately, if people buy technology for three reasons, right? You're either gonna grow revenues, save costs, or a better customer service. Those are the three reasons why people buy technology. And I remind myself that very often as I think about the positions in the trust. So, I think that we may be, there may be some froth in the market, but this has all the characteristics that our process probably leads us to suggesting that this is a secular theme. We did lots and lots of work over the last 12 months talking to developers, talking to companies across all vertical industries. So I'm less concerned about the hype cycle here.
That's interesting stuff, Mike. It illustrates, I suppose, to one degree, something I've noticed myself is that there does seem to be, as you kind of mentioned, a sort of a multi-paced embracement of AI, and some companies seem to have a very clear story, but they're at a different place in terms of actually monetizing that. We have Nvidia that we're clearly seeing huge
Sure.
profitability come through. And then we see other companies that are hinting at the potential down the line, but there's clearly very little evidence at the moment of that showing up in corporate earnings.
Yeah, no, I mean, and that tends to be what we see, right? I mean, I'll just give you the current example, and for those of us on the call, Oracle reported last night. Oracle, I don't think anyone looks at Oracle and thinks, oh, this is an amazing growth story. They are clearly having a product cycle around artificial intelligence and LLMs and what it means to their cloud infrastructure business. And so we're going to see companies that are, look, I think ultimately, just to be really clear here, they're going to be winners and losers. And thus far this year, we've clearly seen artificial intelligence take some budgetary dollars from other sectors. And they're, companies are on various continuums of where they are on artificial intelligence. Ultimately, it really boils down to, if you're using it to enable your products to be better, that should show up in numbers over time, right? You should have higher customer satisfaction. You should have people wanting to expand seat growth. And that's one side of the equation. And I think of that as artificial intelligence enablers. And then the other side of the equation is just the kind of picks and shovels, right? And the companies that are going to benefit from just basically being able to facilitate the use of the technology. And you already alluded to Nvidia, but I mean, if you take a step back and just think about what does it mean to a data center, right? And is it good for DRAM? Is it good for comm equipment? I've often remind myself that when we find these secular themes, it's ultimately a lot of times the first and second derivative ideas that basically give you the best returns. And that's something that here again, we're really spending lots of time thinking about who the beneficiaries are.
Yeah, thank you very much indeed, Mike. I mean, I don't think we want to get too transfixed with AI because it's not the be all and end all of technology. So, I mean, we have lots of other themes going on in the background. Some are related. So, for example, like cloud adoption and edge computing, they have massive implications for AI. But things like new battery technology, cybersecurity, quantum computing, fusion technology. I mean, there's a ton of different technological themes out there that are potentially promising investment areas. I just wonder what when you survey the entire ecosystem, I mean, what other themes really are you really watching quite closely?
Yeah, I mean, one of the things that that it's just some of the broad themes that we, as the trust, have really been focusing on as of late. Continued proliferation of semiconductors, right? Just think about your interaction, whether you hop in a new automobile, whether you think about a piece of household equipment, or industrial applications. Semiconductors continue to proliferate inside of goods. And when I think about companies that also facilitate the movement of power around those semiconductors, those are really interesting spaces for us. In par and parcel with that goes equipment, right? Because you can't design, they're basically three layers there, right? You need to design the semiconductors, you need to produce the semiconductors, and we have nice sized positions in some of the design automation software companies specific to semiconductors. As well as the equipment companies, and in addition to specialized semiconductors as well. If you just think about what it means to be in this digital world, right, where both consumers and businesses are having to meet their customers digitally, right? Cybersecurity comes to top of mind, especially with adversaries that are increasingly sophisticated, and are constantly changing vectors. So that's another sector that we spend a lot of time, looking at. I think the cloud. If you listen to both Microsoft as well as Amazon, they've talked about where we are on the number of workloads that are still on premise versus in the cloud, and we're still early days. I know it for a lot of investors. It probably feels like we've been talking about it for a long time, but we're still pretty early in that cycle. So the good thing about my job is there's never a lack of interesting ideas. The challenging part of the job, and the thing that I remind my team members about, is our job is to find companies that can benefit from the technology, not for technology's sake, excuse me, but in order to grow revenues and eventually grow cash flows, and that shows up in stock appreciation. My predecessor, who basically taught me very effectively, is like, don't get too excited about a given technology. Figure out what customers are using to make their businesses better. And that's kind of my North Star is, as I'm out there talking to, users of technology, what are the tools and technologies that make your job better on a daily basis? And that tends to kind of, help us with respect to figuring out how we spend our time and in what sectors.
So that was Mike Seidenberg from Allianz Technology Trust. I mean, it's been a pretty good year to be invested in stocks and shares, particularly if you take a global approach. And I think despite the bumps in the road over the last few years with COVID and interest rate hikes, inflation, global benchmark stock indices like the MSCI World have still delivered decent gains, particularly if you held for the longer term. And I guess with that in mind, we thought it was worth picking up on one investment trust that's been requested by a few listeners, and that's Bankers Investment Trust. Now, Bankers invest around the world, but performance has actually been a bit patchy, to say the least. So to find out why it's lagged the pack, let's bring on Martin Gamble and Ian Conway, who are going to take a deep dive into the investment trust.
So, Martin, first of all, what is Bankers Trust?
It's been around a long time. It's an investment trust founded in 1888, and it's famous for paying a dividend every year since inception. And it's actually part of the AIC's dividend hero lists because it's raised its payout every year for the last 57 years.
Okay, so that's I'm thinking it sounds like an income story. Is that what it is?
It's partly an income story, yes. I mean, it's got almost a dual mandate, if you like. It's got an objective to deliver better capital returns than the FTSE World Index and to grow dividends faster than UK inflation, which it calculates or uses as a benchmark, the Consumer Price Index. So it's got a dual mandate, and it describes itself as a core portfolio for investors looking for the best global companies.
Okay, so who would this appeal to, do you think?
It would appeal to investors that are looking for income and looking for protection from inflation for that income and looking for capital growth. And I guess it's an all-round kind of portfolio, focused on equities. It's got 1.5 billion, almost 1.6 billion of assets, and it's been managed for a long time by Alex Crook and a team at Janus Henderson, and he's been there since 1994. And as I say, they look to build a global portfolio of equities. They're neutral in terms of investment style; they're neither growth nor income. But that inflation protection is kind of a core part of the process. And the other interesting thing about the way this fund is managed is that they manage it under Alex Crook, but he has 6 regional sub-portfolios all managed by specialist managers. And those regions are the UK, North America, Europe excluding the UK, Japan, Pacific ex-Japan, and China. So those managers pick their best names in those regions, and Alex constructs the portfolio and guides those portfolio managers along the process. It's got no restrictions. It sits in the AIC Global sector, equity sector. And that's how the fund is really set up and describes itself.
Okay, interesting. So how's it done?
Actually, I should have mentioned that when they say good companies, they're looking for quality companies. They're looking for high quality dividend payers in that kind of dividend yield between 2 and 5%. The trust itself has a yield just over 2%. So it's not really an obvious income play in that sense. But they're looking for companies that are able to create their own destinies, whether that's increasing dividends, investing for future growth, or indeed paying down debt. But they don't as I say, they don't put themselves in any style category, but they don't want to overpay relative to the fundamentals that they're buying as well. So how's it done? Well, let's look at it in two different stories, I guess. From an inflation protection and dividend growth perspective, as we said earlier, it's grown its dividend for 57 consecutive years, which is excellent, I guess. And it's grown its dividend by 81%, just over 10 years, versus 33% for UK CPI. So it certainly achieved its objective of growing dividends faster than, or at least in line and faster than inflation. And last year it grew its dividend by 10%, and the board projected that they're going to grow the dividend by 5% this year, 2024. Now, when we look at the NAV,
yeah, so it's ticked the box on that front, and how did it do? So total return.
Yeah, so when we look at the NAV total return, it's again, it depends which period you look at. Over the last 3 years, I guess since we've come out of the pandemic, it's not done that well. It's delivered an NAV total return of around 19%, which is compared to the index return of 35%. But over the last 6 months, things have looked like they're turning around a little bit, because it's produced an NAV total return of 14.3% versus 13.9%. And if you stand back and say, okay, let's look at the really long term, let's look at the last decade, it has delivered an NAV return, total return, greater than its benchmark, but around 19% better than its benchmark. But the share price again has underperformed because the NAV is traded, or the shares are traded at a discount to NAV over that period.
Okay,
so it's a mixed story.
Is it like so many global funds and trusts? Is it simply a case of the benchmark is very skewed because of the Magnificent Seven, and if you don't own all of those, it's really hard to kind of keep pace with it?
Yes, I think that's part of the story here. The manager did point to that reason for the underperformance. Edison, the research group, have done some run the numbers through some interesting analysis on it, and they look at the upside and downside capture. So when the markets go up, how much of that gain does the fund capture, and likewise on the downside. And the downside capture has been around 100% consistently. But since around the time of the pandemic, the upside capture has drifted down from around 90% to 77%. And I think that does speak to some of the concentration that we've seen in markets over the last few years, and more recently, as you alluded to, the Mag 7. And that has definitely hurt performance. And although the US is the biggest part of the portfolio, around 42% of the assets are in the US, that's way underweight relative to the benchmark, which has got around 62% of assets in the US. So not owning the Magnificent Seven and being underweight the US has certainly been a contributor to that recent underperformance over the last 3 years.
Wow. And you mentioned that the NAV been trading at a big discount to NAV. I mean, has the board got any solutions to this?
They have been proactive. Yeah, so the discount's gone from trading in line around 2020 to around 12% discount today. And the board has been active in buying back shares, and the manager believes that has been helping steady the discount and potentially narrow the discount going forwards. The other thing that the board has done recently, which is interesting, is that they've changed the mandate to give the manager more flexibility to buy companies that don't necessarily pay dividends, that may be US Mag 7. I mean, they own Microsoft and Apple already, but they recently added Alphabet and Amazon, and that will give the manager more scope to invest in capital growth rather than dividends. And in order to make that happen, the board has alluded to the fact they may dip into revenue reserves so they can still maintain that dividend growth record, which I think is interesting, but potentially, I guess those revenue reserves that investment trusts use are designed to be dipped into during bad times and built up during good times. And what they seem to be doing here is to capture some more capital gains potentially. They may dip into those reserves to maintain the dividend growth record. We'll see how it pans out.
Yeah, so that is interesting. As you say, global equity with a clear income bias, but possibly having to adapt to the modern world where, they may have to buy companies that don't have great dividend yields in order to and dip into reserves, maybe to maintain that track record.
It seems to be, I mean, I guess a lot of funds are struggling with similar issues with the very narrow leadership we've seen in markets in the past couple of years.
Thanks very much to Martin Gamble and Ian Conway from Shares Magazine. Amid all the excitement around technology stocks, it's easy to jump to the conclusion that all fund managers are just simply focused on the Magnificent Seven and the very biggest companies in the US stock market. And while that is true for quite a large part of the fund management industry, that is certainly not always the case. There is a certain type of investor who actually likes to fish in parts of the market where it looks like a business has actually slightly lost its way, or where the market might be undervaluing its assets. And that investor has a view to finding opportunities where they themselves can actually put pressure on the company to take action to unlock some of the value in their business and hopefully increase the share price. Now, one of these so-called activist investors is Joe Bauernfreund, who manages the AVI Global Investment Trust. And he joins us now to talk about how activist investing works and what he's currently up to.
So, Joe, I think, can we just start the conversation could you sort of just briefly explain what exactly does an activist investor do and how do they actually achieve results?
Well, I suppose an activist investment starts life in a similar way to any other investment. So our analysis determines that a company is cheap, it's got good value, and we see a decent amount of upside from it. But then in terms of realizing that upside or delivering that upside, an activist investor will look at what they want to see change at the company, what they want the company to do in order to deliver that, rather than sit passively and wait for the market to recognize that a company is cheap. So from our perspective, our approach to activism is across the board to engage with management, to have a dialogue, to tell them what we think they ought to be doing or what ought to be changing, and then take it from there. Occasionally, that's all we need to do. Keep things private, keep things constructive. But occasionally, you do have to put more pressure on management, and sometimes things can get a little bit messier, and they descend into public campaigns and sometimes public spats, if you like.
Yeah, I mean, I think we've certainly seen quite a few examples over the last few years of activist campaigns sort of hitting the public domain. Not all of them have worked. So, I mean, could you give me an example of perhaps an activist campaign, either you've done yourself or one that you're familiar with, where it's not worked and perhaps why it wasn't successful?
Yeah, well, we have an ongoing campaign against a company in Japan called SK Kaken. It's a specialist paints business based in Osaka in Japan. It's a company that screens remarkably cheaply. It's got probably more than 100% of its market cap in cash, in net cash. And it's got a pretty decent business with a market leading position, as I say, in specialist paints. There is a family shareholder there who has over 40% of the shares. They are part of the founding family. The founder is the president. He's in his very late 80s, if not early 90s, and comes to the office every day. And they are very traditional Japanese people and resistant to change and resistant to some of the corporate governance reforms that we've seen enacted over the last 7 or 8 years. And they don't want to change. And we've made various suggestions to them about what they ought to be doing in order to get their share price up, in order to get the message out to investors. And they've been very resistant to that. We submit resolutions to AGMs. We've had public campaigns. But it's a relatively illiquid company in stock market terms. And of course, at the annual general meeting, anything that we propose to a shareholders vote, although we get a reasonable amount of support, it's never going to win unless the family wants it to win. So those kind of situations are very difficult, where you have an entrenched shareholder who opposes us. Public campaigns can put pressure on them, but ultimately very difficult to win if the family is not on board.
I mean, when you look for opportunities, are you always looking for somewhere where you can potentially influence management decisions, or Actually, would you, if you just saw something that just looked mispriced, would you be happy to buy that as well?
Yeah, the answer is we're not always looking to influence management directly. As you're probably aware, we invest in family-controlled holding companies, and we hope the management of those family-controlled holding companies are more sympathetic to us than the family behind SK Kaken. But we look for families, or we look for other shareholders or management who are doing something in order to deliver returns to shareholders. So it doesn't necessarily have to be us that is influencing something. Very often, in the case of family-controlled holding companies, what we've seen over the last couple of years is management taking the lead themselves, initiating strategic reviews, trying to understand why their share price is so undervalued and what they ought to be doing about it, what is concerning to shareholders. And that is also very much what we would look for in potential investments. It doesn't always have to be us in the driving seat. It can be others.
Yeah. Okay. I mean, given that you're an investment trust fund manager, do you think that if you identify a company and you have a sort of an activist campaign, do you think that they might look at you as being less of a nuisance than perhaps if you were a hedge fund? Because they've got a bit of a reputation for being very aggressive, don't they?
Yeah. Yeah, I mean, these are generalizations, of course. But there is a perception that some hedge funds are very aggressive, very bullying, and very short-term focused. And we try and cultivate a somewhat different perspective on our approach. We pride ourselves on being more constructive, being slightly more patient, perhaps, being long-term investors. And we don't necessarily need the immediate catalyst to kick in, but we do need to see a pathway to realization of value, and we do need to see some kind of commitment from management towards delivering that. But we specifically try and position ourselves as more constructive than more aggressive, because we think that ultimately that will be more likely to deliver value over the longer term for us.
Yeah. You've had a stake for a while in Third Point, so itself is an activist. I thought that must be unusual. An activist investor investing in another activist investor. Would they sort of look at you and say, you know, no chance in hell are we going to listen to anything that you're going to suggest to us? We know better, sort of thing.
Yeah, I guess the unusualness really stems from the fact that typically the activists, as you said before, are hedge funds, and they're not listed. So for us, as an activist investment trust manager, the interesting opportunity arose because here you did have an activist with a public listing who we thought could do more for their share price and for their shareholders, but by way of addressing their discount, and we thought they weren't doing enough of that. So yes, I don't think it occurs that often.
I spotted a couple of UK listed stocks in your portfolio. If I may just ask a couple of questions on those. First one is Reckitt. Yeah. So obviously the Reckitt Benckiser used to be called. Why are you invested in this company, and where do you see the opportunity for change here?
So Reckitt is a fairly recent new investment for us, and in fact we invested in it shortly after its share price fell 17%, I think it was, in a day on the back of some litigation news out of the US relating to its US business. But fundamentally, the story there is you've got a very high-quality consumer brands business trading at the lowest multiple in many years. Share price has been very disappointing. There have been some operational issues and challenges, certainly on the acquisition front over the last few years. So it's an opportunity to buy into something at a very, very cheap valuation. You've got some uncertainty over the quantum of the litigation, the ultimate litigation liability, but we think that the reaction of the market to the litigation news is exaggerated and beyond what we think is a reasonable final settlement figure. But our case isn't entirely predicated on that. It's much more about the opportunity to invest at a point in time when the fundamental valuation is attractive. And coupled with that, you've also got the emergence of an activist on the register alongside us, and that could be a potential catalyst looking further ahead, and further reinforces the point that there's a lot of value in UK stocks and a lot of interest from private equity investors and activist investors looking to exploit that.
I mean, do you think someone could actually buy, or, try and buy Reckitt at these levels? Or
I don't think somebody. I mean, it's a very large company, £30 billion market cap. More likely that, I suppose they could split themselves up potentially, and certainly that was something that was discussed in the past. Or the company could make moves to improve its margins and improve its operating performance and generate growth that way.
So the other one I wanted to talk to you about was Entain, the gambling company. Well, this has already seen various takeover interests over the years. I mean, I've lost count of the amount of times people sort of say this is a screaming takeover target, but we haven't seen a deal go over the line. The share price is sort of, it seems to be drifting downwards.
Yeah.
What's going on there? Why you feel brave enough to want to own that one?
Well, we came to this via another one of our investments. That investment was a holding in an American family-controlled holding company called IAC. And IAC, amongst other businesses, has a stake in MGM. It owns 20% of MGM. And MGM is Entain's partner in the 50-50 JV in BetMGM, the US business, the US gambling business. So we know that MGM were keen at a point in time to acquire the 50% in the JV from Entain that they didn't own. We know that the share price of Entain peaked at £24. It's now below £7. As you say, it's been on a very sharp downward spiral. We think it trades something like about a 40% discount to the sum of the parts of the various businesses. There are some concerns about the gambling business in the US. There are some problems in the Turkish business, but we think these are more than priced in. And again, there's pressure on management from the presence of a couple of activists on the register. And whilst management have got some work to do on the operating performance, we think there's also a fair chance that there is some kind of corporate activity ultimately that looks to exploit the undervaluation. Bids were received very many at certainly multiples of the current share price.
I mean, I don't know whether it's just applicable to this one or just in general. If you had a position as an activist investor in a stock, I know we obviously hear about sort of suggestions for strategic changes, but does an activist investor ever shop around to try and find an actual buyer for a business, for example, something like Entain, to speed things up?
Yeah, I think it would be reasonable to assume that activists investors would try and understand who the potential buyers might be and what their level of interest could be and at what kind of price. And certainly, if you're going to see management and you're saying your shares are undervalued by X%, and we happen to know that there would be a bidder at a premium to the current share price, it makes management's position very uncomfortable if they don't try and investigate that at the very least.
That was Joe Bauernfreund from the AVI Global Trust.
So we've got time for one more guest on the show this week. The property sector continues to be a hotspot for mergers and takeovers, but not all deals are getting over the line. And Urban Logistics knows all about this, as it recently tried to merge with Aberdeen Property Income, but subsequently pulled out of talks. Now, to explain why and to discuss trends in the property sector, Tom recently caught up with Urban Logistics Chief Investment Officer Justin Upton. Let's hear what they had to say.
Urban Logistics REIT is the only last mile, last box Urban Logistics REIT currently listed at present. Our typical focus is last mile boxes or mid boxes, we call them, 20,000 to 150,000 square feet in urban locations, or as we call it, last touch, the last journey a good will do before it either goes business to business or business to consumer. We IPO'd in 2016. Since then, we've returned shareholders about 106% total return. We are typically at that smaller level of boxes that effectively provide investors exposure to the rental growth we're seeing in that last mile sector. If you look at the MSCI data of the last 12 months, at national level, you've seen rental growth around 7 to 9%. Whilst that's at national level, what we're seeing is really strong demand for that last mile box, where effectively as more companies go online, we see more tenants effectively looking for that last mile fulfillment as part of their effectively national distribution strategy. What investors are looking for in the world today, I believe, it is that sort of certainty of income collection and also the growth of that, which is why REITs as a product are so attractive. Now, if we look at our subsector, as we've seen historically rental growth over the last few years, if you go back to 2020, 2021, that was in double digits. Post-pandemic, it was a huge race for space, albeit Amazon dominated a lot of that. What we're now seeing in the market, and certainly looking forward, take forecasts from CBRE and Savills, all suggesting circa 4 to 5% rental growth per annum going forward, which on top of your rental income or your income yield provides an attractive total return to investors going forward with the ability for growth.
Do you think it's fair to say that in that period you talk about in sort of 2020, 2021, that valuations perhaps got slightly ahead of themselves? And did that create any challenges for the fund, would you say?
It's all quite relative, isn't it? I mean, when your 10-year gilt is practically zero and you have a rental growth of, say, 10, 11% on a Southeast industrial shed, then I could understand why the market was paying in circa around 3% for that. However, obviously post the events of 2022, we've had a rebasing of the risk-free rate of return, and therefore real estate yields have shifted out. Pricing did, obviously in hindsight, look quite full. However, the disconnect between the capital market and the occupational market was quite interesting, that even though if you take September 2022 to September 2023, where you saw a negative capital growth of circa minus 18%, you still saw positive rental growth of around 7 to 8%. So the fundamentals of the product and the subsector are good. What we've just seen is that re-rating of effectively the risk-free rate of return in the gilt market, from which risk premiums are added onto, especially in our space. What I have seen in this market, especially the capital markets, is all throughout that, this has been a sector that's been traded continuously, whereas other sectors, be it offices, which have their own headwinds at the moment, there's been less transaction volume. So investors in the market today, and certainly in my 23 plus years of working capital markets, are very focused on narrow sector strategies, of which logistics, and certainly the urban logistics, are a key focus for them going forward.
Sure. And could you paint a picture of kind of what a typical tenant, I mean, I'm sure you've got, and I've seen that you've got quite a range of tenants, but what a typical tenant might look like for you?
Certainly, I mean, one of the key strategies that we set out when we IPO'd was to issue fashion tenants. There have been countless CVAs since 2014, 15, and that sort of fast fashion tenant is not something that we've really looked for. What we at Urban Logistics are focused on is sort of consumer staples, be it food or pharmaceuticals. We did a capital markets day a couple of weeks ago where we took up a number of shareholders to Peterborough, where we went to see Anglian Water, where effectively it is a storage site on the outskirts of Peterborough storing product for Anglian Water. Now, whilst that doesn't sound the most dynamic area, what it is a key part of their distribution business to the east of England. Mm-hmm. So the typical tenant for us is good credit. We don't compromise on credit because ultimately, going back to my earlier point, that's what's going to pay your rent day one. But also key locations where if you want 50,000 square feet on the edge of Peterborough, we can see rental growth going forward from that. So whilst we underwrite tenants in original an asset like that at around 650, 675 a foot, you're seeing rents now at 750 up to £8 a foot, just playing out that rental growth story.
Sure. And I mean, in terms of opportunities going forward, obviously you were involved in the pursuit of Aberdeen property income earlier in the year. what sort of opportunities are you seeing now, and are kind of there opportunities for, you talked about asset management, is that a source of opportunity for the fund as well?
I think, to take your first question, certainly we looked at API because it was a deal out there that could be done. Obviously, we looked at the market's reaction to the potential custodian and API deal, and it suggested that the market didn't want generalists. Whilst we looked at that deal, and we've looked at a number of both public and private deals, ultimately, feedback from our own shareholders and our own sense, we wanted to commit to stick with the strategy that effectively we've already been running for the last sort of 7 or 8 years. It was a deal that ultimately we decided not to pursue, and ultimately that's off the back of our own shareholders, listening to them. My CEO will always sit there and say, we're not in the business of helping someone else's shareholders out at the expense of our own. If I look at the market as a whole, it feels dislocated out there at the moment. It feels there are assets available to acquire in the capital markets at yields circa 200 basis points cheaper than they were 18 months, 2 years ago. But also you have, on the other hand, a lack of, I think, buyers out there with enough conviction, given the sort of volatility we've seen in the macro markets over the last 12 months. So you take some of the data, circa 5.6 billion was transacted in our sector in 2023. Now, whilst that is down on sort of 21 and 22, it is still in line with the 10-year average. So the opportunities out there are the ability to buy good credit, good assets in our sort of value add space in which we can asset manage, refurbish, improve ESG, with the sort of strong tailwinds going forward of continued rental growth. If you look at the finance market, I would say, again, those fluctuating finance rates have taken a lot of the debt buyers out of the market. So you're sitting here in a market where you can effectively acquire assets without a huge amount of competition. So to have capital at the moment would be useful, because it is a good time to be trying to acquire.
Yeah, thanks to Justin Upton from Urban Logistics. And that's all from us this week. The AJ Bell Investment Trust show is now actually taking a break. We'll be back after the summer with more chat and interviews with experts, more news on investment trusts. Till then, thank you very much for being with us. And don't forget to listen to the weekly AJ Bell Money and Markets podcast, which hits the airways in a few days' time. Thanks for listening. Have a good summer, and we'll catch you very soon.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.